and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture and journey towards my financial freedom. They will cover monthly reviews of my portfolios, financial products and financial well-being so you, like me, can reach your goals and aims sometime in the future. Now let's get into this latest video. This latest video is about my stocks and shares ISA review for the month of September 2022. Quick over in the markets, everything was going great. The FTSE started the following chart at 7284, everything ticking on nicely. We then had some hawkish comments in the US which affected the markets, and then we then have the infamous mini budget in the UK which sent the markets in some kind of free fall and tumble during the last week. And the FTSE ended at the end of the month of 6893, down 5.4% of our portfolio. That affect me? Well, if you look at the following chart, the start of September, the portfolio was worth £66,180, a year-to-date loss of 8%. As was so predominantly based in the FTSE 100, the portfolio finished the month at £64,284, down £1,896, a loss for the year-to-date of 14.7%. Now, the plan for the portfolio is ideally annual return of 10%. We're looking to make dividends of £1,200 and a year-end portfolio value of £80,000. So we were on targets before, obviously, another good month not. During the month, we incurred our normal fees of £11.38. During the month, we made contributions of £2,915. Total to this tax year to date, £14,983.75. And again, look at the following chart, predominantly based in the UK, predominantly based in financial services. With regard to the portfolio, 58.13% is in Europe and the UK, 26.01% is in the Americas, and 15.87% is in Asia and emerging markets. One good thing that did happen during the month, we had our best month for the year to date in receiving dividends. A quick overview of where we received those dividends. So the total for the month was £607.02. Okay. Year to date, £1,501.01. And across our 9 shares which we record, it's given us an average yield of 5.87%, which is well above what the FTSE is paying out. And where did we receive them dividends? Well, nice start of the month for Lloyds Bank, £128.77. Now we reinvested, gave us 272 new shares. NatWest gave us £168.89. Now we were going to get them reinvested, but because it was kind of restructuring, that option wasn't available, so that will go into new funds later on. Barclays, the bank, gave us a nice dividend of £34.17. Again, reinvested 19 new shares. Legal and General gave a very nice dividend of £156.56. Again, reinvested 67 new shares. And Aviva, the insurance company, £100.63. Again, reinvested 25 new shares. And then finally, HSBC, the bank, £18.60. Now we won't reinvest that because of the value. It's not worth it, shall we say, in fees and charges. So a very nice month. And the shares did collapse at the end of the month, but the likes of Aviva and Legal and General, we bought them shares at greatly reduced prices. Let's dive into our holdings and our portfolio and some recent news events. So, with regard to our shares, total value of £26,453 makes up 41% of our portfolio, of which 37% is in the FTSE 100 and nearly 4% is in the FTSE 250. Now we do own 9 shares, being dramatically affected this month obviously. We've now only got 2 in profit and 7 in loss. and some recent results of note during the month. Okay. Card Factory, one of our providers, interim results. Now, store revenues or like-for-like sales was up 6.1%, but total revenue was up 69%. Back in profit, £14 million against a loss last interim of £6.5 million. It is continuing to open new stores. It is doing a trial for click and collect, but it does have some debts. Now, there is very cash rich, the debts are being reduced, but unfortunately it cannot pay dividends until them debts are being cleared because of some kind of banking covenant with the government and the loans they've got. But they do expect them debts to be cleared ahead of schedule, ideally by January 2024, and then which point they can resume paying dividends. Now, if we look at the following chart, a quick overview of where our 9 holdings are held and the values and what percentage they make of our portfolio. Our biggest shareholding this month, it's got a new one, it's Lloyds Bank. We own 16,369 shares. Nearly £7,000 makes up 10.5% of our portfolio. Has suffered during the month, but it did give us a very nice dividend. Legal in general, we've been increasing in the last few months because it's paying a very nice yield of over 7%. We now own 2,945 shares, just over £6,000, nearly 10% of our portfolio. Our next company is another insurer, Aviva, 1,129 shares, £4,382, 7% of our portfolio, but again, a very nice yield of nearly 7%. Barclays is our next shareholding, 1,638 shares, £2,200, 3.4% of our portfolio, and again, gave us a small dividend, but those dividends will increase. Now, hopefully, with the banking sectors, interest rates will increase, profit margin will increase, which will result obviously in better profits, better dividends moving forwards, which will all be reinvested. And then the final share had some kind of restructuring during the month is NatWest. Holdings reduced, we're now down to 722 shares, £1,743, 2.7% of our portfolio, but it did give a special dividend. It was paying a yield of around about 11%. And then away from the shareholdings, Sainsbury's the retailer, 831 shares, £1,448, makes up 2% of our portfolio. Everyone needs food, it does pay some dividends, but it is struggling because of this so-called cost of living crisis. Prices are going up, food's going up, the costs to run them stores are going up, but hopefully a short-term blip. Our next holding was one we've discussed earlier, but results is Card Factory, 2,871 shares, £1,242, makes up nearly 2% of our portfolio. And as we said, some very good results in the month. Hopefully dividends will be increased, and it is a very cash-rich company in normal times. Our next holding is AJ Bell, the platform provider, 432 shares, £1,162, 1.8% of our portfolio. And then finally, HSBC, 236 shares, £1,100, 1.72% of our portfolio. But again, it is restoring dividends and it will pay quarterly dividends in the future. Now, we did reinvest our shares. We did purchase a new share. During the month, we increased our holdings in Aviva. We purchased 127 shares at a cost of £570. So, a collection of shares predominantly based in the UK, obviously, predominantly based in banking sectors, but it has given some very good dividends. We have struggled during the month because of what's happened with the mini budget, and unfortunately, the banks, the insurance companies were greatly affected because of what happens, and the markets hate one thing, which is uncertainty. Moving on to the funds held within our portfolio. So a quick overview of the assets and the type of funds we hold. Our total funds are worth £37,666, makes up 58% of our portfolio. Now, We do own 13 funds. Struggled during the month because of what's happened on the global markets. Now we've got 5 in profit, 8 in loss. Now during the month we saw it as a good buying opportunity to increase existing holdings. We put £500 into a technology fund, which is against nearly 300 companies, but it was done at a reduced price to what we bought earlier. And we put £1,400 into a passive adventures, some kind of tracker fund. It was done again to increase an existing holding and to take away from our sentiment because we were solely UK based. So let's look at some of our biggest holdings. Say our passive adventures fund, nearly £11,000, makes up nearly 17% of our portfolio. Okay, very small cost, 0.3%, but it's just, we can just switch off, leave it. It will invest across all sectors around the world and give us some great diversification. We've got a legal and general technology fund, £5,800, 9% of our portfolio. A global equity fund, £3,500, 5.5% of our portfolio. And quite selective, the Bally Gifford Positive Change owns about 25 to 30 stocks, all green ESG, £3,400, again round about 5.3% of our portfolio. We own a US smaller companies, £3,157, 4.9% of our portfolio. Now it was showing a very nice profit, has struggled recently, but it's obviously affected by the sentiment of fiscal policies in the US at the moment. Our next holding is somewhat struggled. It's a China fund, £2,900, 4.5% of our portfolio. China and emerging markets have struggled this past 12 months, but ultimately China is a major player and it will be the biggest economy, they reckon, between the next 10 to 15 years. And then our next, shall we say, fund of note is a mid-cap fund, nearly £2,000, 3% of our portfolio. And then right down to our smallest fund is a fund in Russia, £260. Okay, we did put £500 in, it did go to £600, now reduced because obviously what's happened with Russia and Ukraine war, but thankfully it makes up 0.41% of our portfolio. So a nice collection of funds, and all the funds we've got no plans to sell between the next 3 to 5 years unless market sentiments change. But it just goes to happen what can happen in a short-term market. The aim, as I say, is to think long-term. It's to make 10% year on year on profits, and all the dividends will be reinvested back into existing companies or into existing fund holdings. So hopefully meet our targets. Remember, it's not a get-rich-quick scheme. If you like the videos, smash the like button, subscribe to this channel, and we'll see you again in the next video.